Chapter 7, Part 1. Now we're going to do budgeting, and we're going to start with the production, materials, labor, and overhead budgets. Now, budgeting. It's a plan for a specific period, helps management, it sets a target. Where are they going? And can they achieve it based on their current resources? Used to estimate future costs and revenues, and they're going to develop. It's going to act to control, plan, and act. And a lot of corporate, I used to work in the budgeting department. I used to do a lot of budgeting, and we'd redo that budget a lot of times because people always want that one number they're looking for. So that's how you start off. So what are the benefits? A lot of benefits. One is focus on future opportunities and threats. So when do you have to take action. It provides benchmarks. You can measure how different areas are performing, and it gives employees an idea of what's going on. So, motivate, budgeting, performance levels, but this is only true if the employees help develop the budgets and help coordinate activities. So, let's start with our budget. Now, one thing you have to remember whenever you're doing a budget, you always start with the master budget. You always start with sales. That drives everything. So the first thing you do is you come up with how many sales are you going to make in units and dollars. So the master budget includes individual budget for sales, production, if you're a merchandising business, expenses, capital expenditures, and cash. You also want to have an idea of are you going to have enough cash to get through the year. The process ends with preparation of the financials. So you have to do all these other budgets first before you can do your financial statements. So this is a nice diagram, I think, that kind of gives you an idea. Remember, you always start with sales, and sales always has to be in dollars and units. You need the dollars to do the financial statements, but to use the units to do the production budget, which will lead to how much material you need, labor, and overhead. The production is always in units, it's never in dollars, because now this is for a manufacturing process, because you're going to take materials, direct labor, and factory overhead and make something. Direct materials, direct labor, and factory overhead are going to be in dollars, and so are the rest of the budget. So again, we start with the sales budget. The sales budget is going to be the number of units to be sold times the sales price. That's going to give you your total revenue. Okay, you always start, remember, with sales, and that's in dollars and units. You need to use the units to calculate the production and material budget, and you need the sales dollar for the income statement and the cash budget. So, sales budget is pretty easy, just units times dollars. But now we're going to do the production budget. Now that's a little more complicated because the production budget is based on unit sales projected in the sales budget along with inventory considerations. Let's face it, you should not bring your inventory at the end of the month down to zero. At no time should your inventory be zero because you always have to have products to sell. So, the production budget, we're going to start with units needed for sale plus desired ending inventory, and that's usually a percentage of the next month. A lot of times they'll say we need 10 to 20% of our next month's sales in inventory. Now, then you're going to subtract what you already started the month with, and that will tell you your units to produce, which is what you're going to use for your material budget. All right, so now let's take a look at a nice little example. Now we have Tyler Company budgets the following unit sales for the next 4 months. You need 4 months, okay? And the reason you need 4 months because how can you estimate ending inventory if you don't have the following month's sales projections? So for instance, in June, we need July to do the projection. And you'll see that when I go through this. Now, in this case, they want to have a 30% of the next month's inventory and ending inventory every month. And they also have to tell you at the end of March, they had finished units of 900. So now we can do our production budget for April, May, and June. So we're going to start with our budgeted sales units, and you usually will do this month by month because whatever you get in one month carries over to the next month. And I'll show you that. Desired ending inventory, we're going to take the following month, May's units, times 30%, and that tells us our desired ending inventory is 1,200, plus what we want to sell, which tells us our total required units is 4,200. Now, if we had no inventory left over from the prior month, that would be our units. But since we do have some in beginning inventory, we have to subtract that from our total required units, and that tells us how many units we have to produce, and those are going to be the units we're going to use to determine our materials budget. Now we can go ahead and do May. Now, in this example, again, it provides you that number for May. But when we do this part of it, remember, you have to take the next month's units times what you expect to receive so we can get our desired ending inventory. We're going to add that with the 4,000 to get 5,800. And then we're going to subtract out the 1,200 we had as desired ending inventory from the prior month, because ending inventory from the prior month is beginning inventory in the next month. All right, the last month, we're going to take our 6,000 we have, and then we're going to take 30% of July's expected budgeted sales. So we can come up with our desired ending inventory. We're going to add the 6,000 plus the 600 to get 6,600. We're going to subtract the beginning inventory, which we got from May, as the ending inventory, and that tells us our units to produce. Now, this is what we're going to use to prepare our materials budget. Now, computing the materials budget, we're going to take the information we got from the production budget. So you always have to do the production budget first, because otherwise you're not going to have the units. And now what we're going to do is we're going to prepare the direct materials budget. So it's going to be the units to produce times how much material, remember to do this, times the materials required per unit, plus desired ending inventory minus beginning materials inventory. So again, it's going to be the quantity of direct materials needed for production in units times the materials per unit plus the desired direct materials ending inventory gives you total quantity of direct materials needed minus beginning inventory. And then we're going to take that number times cost per quantity to get the materials budgets in dollars. So again, the material budgets is going to end up being in dollars. It starts with quantity, ends in dollars. So here's a nice little example. In this case right here, we're going to do it by month. You'll always start, okay, these are the units that we want to produce for each month. We're going to take it times the pounds per unit. And then what we're going to do is add in the desired ending inventory. So we're going to take, for April, we're going to take May's materials needed for production times the 30%, and that's how we get the 855, and we're going to do that for June, and we're going to do that for July. And that's how we end up with our desired or pounds required. And then, of course, what we have to do is always subtract out what we already have. Now, they gave you the beginning inventory for April, and then you calculated it from May. You're going to take that 855, and that's going to be their beginning inventory for May. And the 840 is the ending inventory for May, becomes the beginning inventory for June. So remember that to work those numbers. And then you're going to take that times the $4, and that tells you your cost of materials. Now, the next thing we're going to look, this is the direct labor and overhead budget, I think, are really easy. So All we're going to do is the cost of the direct labor equals the units to produce times the amount of hours you need per unit times the direct labor cost per hour. So, in this example, units to produce for March are 3,300 and 4,600 for April. We're going to take that. It says we need a half hour for every unit. And then we're going to take that times $18, and that gives you your cost of your direct labor. That's pretty easy. Now, the next one we're going to look at is overhead. Overhead. You have to remember that you need to include both the variable and the fixed portion. So here we go. We've got this budget, and they give you all these. So what we're going to do, again, is start with units produced. How much labor we need for each one of those units, same, it's a half hour. And then we're going to take that times the variable rate, but we're not done. We have to then add in the fixed factory overhead, and that tells us our budgeted overhead per month based on the information provided from your production budget. And that ends part 1.